Yo, what's going on YouTube? Today we're going over 10 buy and hold forever dividend stocks. So once you buy them, you literally never have to sell them. And for them to be on this list, we look at a couple important things. So first we look at the free cash flow versus how much their dividend costs them. So do they actually have a lot of room to raise their dividend? We also look at how much cash they have on hand compared to the market cap, and we look at the total common shares outstanding. So we see, hey, are they diluting you as a shareholder? Because the more they dilute you, the more dividends they have to pay, and that's just less returns for you. So yeah, let's actually check out 10 dividend stocks that you should buy and hold forever. I really would appreciate if you'd hit the like button for me, and let's just get straight into it, because this first one is actually a very safe one that we all know of. It's ticker symbol WM, or Waste Management. I won't spend too much time on this one because this one we all know. But first off, look at the stock price. Since 2020, it's gone up like crazy. Market cap of $64 billion, but more importantly, let's go look at their numbers. So net income of $613 million, but more importantly, we want to look at the operating cash flow, which is $1.03 billion, all right? So $1.03 billion, their dividend literally only cost them $283 million. And if we scroll down and go to the Ishmael Retirement of Stock program, they're actually buying back more stock than paying out in dividends. So that's pretty cool to see when the company's buying back stock and it's paying out dividends. The only thing I don't like is their cash on hand. It's only $144 million. It seems like that's pretty normal when we compare it to 2021 and 2020. So yeah, it doesn't look like that's too big of an issue. But yeah, let me know your thoughts on this one. And let's go ahead and get right into the next dividend stock. All right, so the next dividend stock is actually Texas Roadhouse, ticker symbol TXRH. Now, I normally wouldn't include a restaurant, but this one has really good financials. And as you can see, they had to cut their dividends. So even though they had to do this during the pandemic, like all restaurants did, I still think this one's a buy right now. So they're actually yielding 2.26%, which isn't crazy, but I want to actually show you the numbers. For a restaurant, they have some very impressive numbers. So look at this, free cash flow per share of $1.48, and their dividend only cost them 55 cents. So let me show you that in actual numbers. Here's their leverage ratio for a restaurant. For it to go down year over year, that's crazy. It went from 59% just about to 56% with more assets and less debt. So look at this, cash flow of $99 million in the most recent quarter. So how much does the dividend cost? It only cost $36 million. So they can easily afford that and raise it if they wanted to. And if we go to their retirement of stock program, they love their own company so much that Texas Roadhouse is buying back a lot of stock. Look in the most recent quarter, they bought back $26 million, which is really cool to see because that's returns for you as the shareholder. So if we go to their total common shares outstanding, is down from 1 quarter and 1 year ago, is at 66.84 million. So yeah, that's Texas Roadhouse. Even though they did cut their dividend, like I said, I still think this one has a lot of room to grow it. They're buying back their own shares. And for a restaurant, no other restaurant is really doing that right now. The only one that's doing it is ticker symbol DRI, and they own like Olive Garden and Longhorn Steakhouse. But yeah, that's Texas Roadhouse. Let's get into the next dividend stock. All right, so the next dividend stock, this one out of all the railroad stocks is the most safe one in my opinion. I did analysis on all of them, and the most safe one in my opinion is ticker symbol CP, or Canadian Pacific, and now it's Canadian Pacific Kansas City because they bought back Kansas City Southern. So now they have a railroad that goes from Canada all the way through the United States. So yeah, anyway, let me show you the actual numbers. So this is the number we want to look at. The cash flow per share, 95 cents in the most recent quarter, and their dividend, it's Canadian, but it's the same thing. It costs 19 cents. So to put this into better perspective, also for the railroad, they only have 48% assets to liability ratio, which is lower than than every other railroad company that was out there. So yeah, here's the real number, $893 million. So 893, how much does a dividend cost? Literally $176 million. So they can raise it a ton. They could double it if they wanted to. And if we go to their total common shares outstanding, they haven't been diluting you. It's only up 0.15% from 1 year ago. And yeah, I really like this one. It's in the railroad industry. It's super safe. They have super good margins. They're not going anywhere. Super good moat. You can't build any new railroads. So yeah, don't worry about this drop right here. That's a stock split. It's kind of glitched because Weeble sucks. But yeah, that's ticker symbol CP. Let's get into the next dividend stock. All right, so the next dividend stock on the list is ticker symbol ARCC. And just like REITs, they have to pay out 90% of their taxable income. So they have really high dividend yield. So as you know, as the stock price go up, the dividend yield gets lower. And even at these super high stock prices, ARCC yields over 10% still, which is crazy. And I'm going to show you why they can still afford it. So for this, we actually want to look at their operating income. So $320 million in the most recent quarter. Now remember, interest rates actually help out these kind of companies. So if we go to their how much their dividend costs, it only costs $253 million, which they can easily afford. And how much cash do they have on hand? So hey, they have $411 million of cash on hand. Not too bad because the market cap on this sucker is $10.66 billion. So yeah, this is their dividend history. They even sometimes do these special dividends like they did right here, but they raised it from 40 cents to 48 cents while paying you the special dividends, which they could do in the future. So yeah. So that's why I really like ticker symbol ARCC. It's like a dividend investor's dream. All right, guys, the next stock is ticker symbol ASML. I would be more than comfortable holding this one for the next 10 plus years or forever, like I said. So look at the dividend on this one. It's yielding only 1.05%. But if we go see how much like they're paying out, it's different every single quarter. As you can see, last quarter it was $1.85. Now it's $1.59. And let's go ahead and look at their numbers because this one's in the semiconductor space and they have just such good technology. I love ASML. All right, so look at this. They had net income of $1.88 billion. All right, so $1.88 billion, and their dividend only cost them $666 million. And if we actually go to their Ishmael retirement of stock program, they're also buying back tons of their own stock. They're doing both, which you love to see. So if we go to their total common shares outstanding, it's actually down 2% from 1 year ago. So that's pretty cool to see. If we see how much cash they have on hand, they have $6.34 billion of cash, up 54% from 1 year ago. It looks like they're at a pretty healthy cash position, so I like to see it. So yeah, this one I would have no problem holding for the next 10 plus years. The growth on this one is just crazy. It doesn't follow Nvidia chart because Nvidia is a lot higher, but I think this one still has a lot of room to grow. Yo, so the next dividend stock on the list is ticker symbol Cube. This is CubeSmart. This one's actually a REIT, a real estate investment trust. It's in the self-storage sector. Its dividend yield is 5.3% right now. So it's at a pretty good yield right now, but more importantly, we want to look at their core FFO because this is the number they pay out the dividend from. It's up 5% year over year at $161 million. And if we see how much does their dividend cost, it only cost $110 million. Remember, REITs have to, by law, pay out 90% of their taxable income. So that's why they have these really high dividend payout ratios. And if we go to their total common shares outstanding, as we know, REITs like to issue a lot of shares to raise capital, but not CubeSmart. It's only up 0.15% year over year. So basically nothing. They haven't been issuing any shares. And if they did, it would be really bad because the stock price is at a low valuation. So it makes sense to raise shares at a high price, not at a low price. So that's ticker symbol Cube. I really like this one. You can get exposure to the self-storage industry and get the high dividend yield. All right, guys. So for the next dividend stock, this one's actually at a great price right now. It's ticker symbol DG or Dollar General. They're only yielding 2% right now, 2.04%. But I'm going to show you why the financials aren't even looking that bad for this one. So let's look at the actual numbers right here. So $535 million in the most recent quarter, and their dividend cost $129 million. So obviously they have room to grow it. But one thing I like is if we go to their Ishmael retirement of stock program, they used to buy back so much stock. They've paused it for the most recent quarters, but they used to buy back, 500 million to $1 billion of their own company back. And if we look at the market cap, assuming they buy back $1 billion sometime in the future, the market cap is $25 billion right now. And that means whenever they buy back their own stock, they can raise the dividend. And they could even raise the dividend right now because it's only $129 million and the cost is going down because they're buying back their own stock. And hey, if we go to their cash on hand, $353 million isn't bad. Seems like that's normal for this company. So yeah, they don't seem to be in an awful situation. I just think with the high interest rates, it really is affecting them because Dollar General doesn't have the best margins. And when interest rates go up, that doesn't really help them. So yeah, that's ticker symbol DG. I think in the future, this one will recover and get back in place. But yeah, let's get into the next dividend stock. All right, guys, the next dividend stock on the list is ticker symbol UPS or United Parcel Service. So they're actually yielding 4.24% right now. Who knew they're yielding such a high yield? And as we can see, the stock price over the past couple years hasn't done too good, but right now, I personally think it's at a good deal. So let's go ahead and look at their numbers. So their leverage ratio has gone down 5% from 1 year ago. That's good to see. But more importantly, this is the number we want to look at. $3.24 billion. All right, it is down from 1 year ago, but it doesn't really matter because there's still a lot of money to be given to shareholders because only half of that 1.34 billion is paid out in dividends. What is the rest of the money doing? Well, they're buying back their own stock. Instead of buying back stock, they could raise their dividend, but I like when they buy back their own stock. $677 million in the most recent quarter. So if we go to their total common shares outstanding, it's down 1.72%. So that's insane. I really like to see that with such a basic company such as ticker symbol UP. So yeah, let me know your thoughts on this one, and we'll get into the last couple dividend stocks here. All right, for the next dividend stock, this one's actually a REIT known as ticker symbol PLD. This one's at a good deal right now, and this is the largest REIT in the whole world. Has the largest market cap, or at least in the United States. This is the biggest U.S. REIT in the whole world. And if we go to any REIT ETF, like a REIT ETF, like the Vanguard one, the Spider one, this one is always the largest holding because it's market cap weighted. So let's actually look at their numbers because for REIT, they're not that leveraged, 37%. They actually just acquired Duke Realty 3 quarters ago. That's why their assets bumped up so much. But let me show you their numbers here. So this is the number we want to look at. This is the core FFO. So $1.22 billion, all right? So $1.22 billion, and their dividend only cost $807 million. So they have room to grow that if they wanted to. If we go to their cash on hand, $535 million, not too bad. So yeah, I really like this one. The dividend growth is super impressive. So it yields 3.37%. But look at it, it went from 79 to 87 in the most recent quarter. In 2020, it was 58, all the way up to 87 now. And in 2 quarters, they're going to raise it again to who knows what, maybe 90, 95 cents. I don't know. Remember, nothing in this video is financial advice. I'm just some random YouTuber telling you some stocks that I like. So obviously do your own research, and let's get into the last and final stock, which actually isn't a stock. I just wanted to, kind of prank you guys. This one's actually a ETF known as ticker symbol JEPI, and this one's a covered call ETF. And let me show you its top holding. So they actually sell covered calls on these, and part of the actual dividend that they pay out monthly comes from the dividends that these stocks actually pay out. So as you know, you recognize all of these. I actually have a list of every single holding in JEPI right here. And let me search it by market cap. So here's this filtered by market cap. Obviously, you know all these companies right here. I'll just scroll through them. Maybe you can pause the video if you want to actually look at them. Yeah, thank you guys so much for watching. I really would appreciate if you hit the like button for me. It helps out a ton. Also, subscribe if you're new if you like how I break down all the numbers. And yeah, hope you guys have a fantastic rest of your day. My name's Nathan Robert.